Good morning and welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. A brand new week and looks like we are poised to start it on the back foot, given the fact that global cues are fairly subdued. US futures are holding out after a weak session on Wall Street on Friday, but Asian markets are definitely on the back foot. You have the likes of Nikkei, Kospi, all these indices are trading with cuts of anywhere between 1 to 2%. You've got some economic data coming out of China as well, retail sales data, and that has not really come in as per expectations. It has come much weaker than what the street was really anticipating. So that's another factor that's contributing to the weakness when it comes to Asian markets. You also have the GIFT Nifty that's hinting at an 80-point cut. So it looks like we are poised to start below that 26,000 level after reclaiming it on Friday. We did see back-to-back sessions of gains last week, but still for the week we were down somewhere around 0.5%. So looks like we would be iffy at start, but let's see whether or not some value buying emerges after the recent correction, whether our markets managed to hold out despite weak global cues. We'll really watch out for that once the market really opens. But lots to watch out for. We've got two new listings today, Corona Remedies as well as Wakefit. Both of these companies will make their stock market debut today. The listing is at 10 a.m. And lots of other stocks will also be in focus, particularly the insurance names. Cabinet has cleared 100% FDI in insurance, and that could, of course, pave the way for more foreign capital for some of these, insurance companies. And that, of course, may come as a booster. And we did see the likes of HDFC Life, SBI Life already rallying in Friday's session. So let's see whether or not they manage to extend some of those gains or not. Of course, all your stock related queries will also be in focus. So keep them coming in. We will get them addressed as well. But before we move any further, quickly take a look at the top stories at this hour. US stock futures hold steady after negative close in Friday's session. Sharp fall in technology stocks like Broadcom and Oracle led the decline. Asian markets, meanwhile, have started the week on the back foot. The GIFT Nifty, of course, suggesting a lower start for the Indian market. Crude prices edge lower on supply concerns and hopes of a Russia-Ukraine peace deal. Gold, meanwhile, shines at a 7-week high, while silver holds steady around the record high levels. Insurance will be in focus. Stocks, given the fact that Cabinet has cleared 100% FDI in insurance sector, new legislation provides more teeth to regulator IRDA and allows merger of non-insurance companies with insurance companies. Composite license and open architecture clause not a part of the bill for now. Corona Remedies and Wakefit will be listing on the exchanges today. Corona Remedies issue saw a strong subscription, while Wakefit's 1289 crore rupee public issue saw moderate demand. Inflation rises from record low to 0.7% in November, remains well below the RBI target range of 2 to 6%. Food prices, meanwhile, shrunk by nearly 4%. Economists see scope for another rate cut by the central bank after the last rate cut that we saw in the recent RBI policy meeting. All right, then let's take a look at how the week really panned out, the last week for our markets. We of course did end lower. We saw back-to-back gains on Thursday and Friday for the markets, but even then we clocked in a 0.5% cut for the week. And in terms of sectoral movers, except for metals, all the sectoral indices ended the week in the red. Metals were good, were doing good, and they were shining bright throughout the week. That was, of course, because of the weakness in the dollar index. The dollar index, of course, was perched at multi-week lows. This morning, of course, it is rebounding. It is around that 98 handle, above that 98 handle, firmly above that 98 handle. It strengthened just a wee bit after hitting multi-week lows. So let's see today what metals really do. But metals last week did fairly well. But on the lower side, or on the other side, you had defense names that were dominating the laggards list, and so were the PSU banking stock. Both of these sectors saw profit booking as well. In terms of the individual movers, Interglobe Aviation, Asian Paints, Bharat Electronics, HUL, these were among the top nifty laggards. Asian Paints, of course, in recent times has seen good traction, perhaps came under some profit booking last week. Hindalco, Grasim, Tata Steel, Eternal, these were some of the top gainers last week. Eternal, of course, also has been witnessing profit booking on and off, but last week turned out to be a good one for Eternal. And as I mentioned, metal names did well. So you had the likes of Hindalco, Tata Steel dominating the gainers list. On Friday, in particular, we saw the Nifty gaining for a second straight session. As I said, our markets clocked in back-to-back gains. Nifty did manage to reclaim that 26,000 level. And now, of course, 26,000 will act as a crucial support zone, and experts believe 26,200 will be a major resistance zone for the Nifty. Mid-cap index managed to outperform on Friday. That's something that the market will take heart from, because the broader markets, of course, have lagged. And at a time when the benchmark indices were hitting record highs, we've had stark underperformance in the broader end of the markets. But the market breadth was also in favor of advances on Friday. That's another good sign. Because of late we've seen the broader markets doing extremely weak, and of course we've had the breadth largely in favor of declines. So this trend on Friday turned out to be fairly good. Except FMCG, all the sectoral indices ended higher on Friday, led by metals and real estate. Real estate is another pocket that's been extremely beaten down, but saw good traction in Friday's session. Hindustan Copper, Tata Steel, Hindalco and other metal names were rallying 3 to 7% on Friday. Of course, we know silver prices have been hitting record highs consistently, and Hindustan Zinc, that's of course one play on silver, and that stock was extending its gains as well. It rose somewhere around 14% in 4 sessions. So yes, that stock. Of course, today we have a brokerage note as well on Hindustan Zinc. We'll talk about that as we go along, go forward in the show. But another thing that deserves mention is the currency. The currency hit a record low of 90.56 vis-a-vis the US dollar intraday. I think it shot sharp somewhere around 90.42 or thereabouts. But yes, it did make a fresh record low of 90.56. In terms of fund flows, foreign investors, of course, year to date they have pulled out $18 billion. On Friday they were net sellers to the tune of 1,100 crore rupees. DI buying support continues, and they bought shares worth somewhere around 3,850 crore rupees or thereabouts in the cash market. But yes, all in all, that's the texture for the market. And in the pre-open as well, we are looking at a 0.5% cut. In fact, the Nifty is showing a 110-point cut in the pre-open. So yes, we are poised to start on the back foot. But the key question is whether or not there could be some buying interest at lower levels, and whether we can defy the trend when it comes to how the global markets are really doing this morning. So yes, lots to talk about. Let's bring on board our first guest for today. Joining me is Rajesh Palviya, Senior Vice President Research, Head Technical and Derivatives at Axis Securities. Rajesh, lovely chatting with you. 2 back-to-back sessions of gains, although last week we clocked in a 0.5% cut. But this morning things aren't looking all that rosy when it comes to the global markets. GIFT Nifty pointing to a triple-digit cut, and in the pre-open we can see that happening. So do you think 25,900 could be tested on the downside, or do you think there could be some buying support that would come in and we could actually go ahead and defy how the global screens are really looking this morning? What's your sense?
Good morning, Nandita. So looking at the overall closing on the previous week, it looks like that if we continues to hold about 25,900, yes, trend is likely to exhibit on the bullish side, as short covering action has already played out in the previous trading session, and Nifty was able to again close about 26,000 level. Looking at the put based concentration, the major put based concentration is placed at around 25,900, 26,000 strikes. So these two levels are very important and critical for today's trading session. So in initial opening, I think if 25,900 is able to protect by Nifty trader, then I think yes, there would be some buying action from those level. At this juncture, we are suggesting to keep a stop loss of 25,850. Buy on decline is a strategy. And on the higher side, the first resistance, which is there at 26,100 to 26,200, this is the major supply zone based on the call concentration area. So these levels are the target for near-term trading perspective. But for Bank Nifty, again, Bank Nifty manages to cross 59,000 level. So that's the positive sign for Bank Nifty, as 20-day moving average is protected by Bank Nifty. So if we able to defend 59,000 level in gap down opening or in minor decline, I think here we may see, again, buying interest will attract, as overall structure for Bank Nifty and banking stocks are on the bullish side. And we believe that, once Bank Nifty crosses above 59,600, here we could see a good amount of short covering action to play out, and possible extension of rally to 59,800 we could see in the near term perspective. So overall, at this juncture, buy on dips would be the strategy. Structure looks like on the positive side, so I think buying will emerge around lower level if we trade around 25,900 950 zone.
Okay, buying could emerge at lower levels if we hold above that 25,900, and buying on dips would be the strategy going forward as well. Just about looking at market open, the first ticks coming in, and of course not positive, but not that bad either. We're just about down 50 odd points on the Nifty, 25,980. That's where we are at. The Sensex is down 170, 85,060 or so. The mid cap index moving largely in tandem with the benchmarks. Down about almost 0.5% or so. In fact, slightly underperforming the indices. The advanced decline ratio skewed in favor of laggards once again. So yes, that reversal has happened given the fact that on Friday we had the advanced decline ratio favoring the gainers. But today, of course, at the start itself, we are seeing that trend emerge once again. When the broader market picture isn't looking all that great. But let's take stock of some of the sectors then. As I was mentioning, metals was one pocket that managed to do well through the week, top sectoral gainer last week. But today, no such luck. I can see, most of the sectors are trading in the red, starting with the bank Nifty that's down, marginally, but nevertheless, the texture is on the downside, 60 points down. On the Nifty Bank Index, it's at 59,300 or thereabouts. In terms of other sectors, I think the biggest laggard this morning is the pharma basket, that's down 0.6%, followed by real estate, that's also down 0.6%. Auto out of favor in reverse gear. IT is also down 0.5%. PSU Bank Index is down 0.3%. FMCG down. So yes, the texture is on the downside, but I don't know what's really happening with PVR Inox. That stock is up almost 4%, and that's keeping the media index, the Nifty media index, afloat. That index is up in excess of 0.5%, the sole gainer when it comes to the sectoral picture. In terms of the individual movers, then I can see the list of gainers is extremely slim. In fact, just about 4 or 5 names, on the gaining side. You have Shriram Finance, that's up 0.5%. Interglobe Aviation, after the drubbing it has seen in recent times, some buying coming in there. It's up 0.6%. Asian Paints is another one. Last week it was out of favor, but it's up somewhere around 0.3%. Bharat Electronics, Hindalco, ICICI Bank and ITC. So these are just about a few handful of gainers on the index as we kickstart trade for the week. Trent, that's the top laggard. That stock is down 1.5%. YTD as well. The stock has really been hammered. It was a showstopper stock last year, but this year, of course, completely out of favor. It's almost half from its 52-week highs as well. I think it was somewhere close to 52-week lows as well. M&M, ONGC, Eicher Motors, HDFC Life is also on the back foot. So all these life insurers, I think some profit taking after the recent up move. Eternal also has slipped into the red after clocking in a good week last week. But to talk about insurance stocks, the Union Cabinet has approved the changes in the proposed insurance amendment bill, and the legislation proposes amendments to the Insurance Act, the LIC Act and the IRDAI Act, including a provision to raise the FDI cap in insurance companies to 100%. The changes are aimed at widening capital access, simplifying licensing requirements and strengthening governance across the sector. The bill also aims to amend 3 key laws, the Insurance Act, as I mentioned, the LIC Act and the IRDI Act, with provisions intended to expand access to capital, streamline licensing norms and strengthen governance frameworks across the sector. The changes form part of the government's broader objective of achieving insurance for all by 2047. Of course, the amendment, as I said, will raise the FDI limit in insurance companies from 74% to 100%, and this will help in attracting stable and sustainable investment, facilitate technology transfer, enhance insurance penetration and social protection, and aid achieve the goal of insurance for all by 2047. Of course, India has about 70 insurers while the world has close to 10,000. Even if a small share of these chooses to enter India, the capital coming in is expected to be very, very large. Anything that you like here, Rajesh? SBI Life, HDFC Life, off late they've had a good run, but SBI Life completely outdoing or outpacing HDFC Life and LIC both. LIC, of course, we've seen, if you look at the month a monthly chart, 3-month chart, 6-month chart, you'll see that it has given negative returns. But how would you approach insurance, especially after this development?
So if I analyze all the stocks from the insurance basket, I think HDFC Life as well as SBI Life, these two stocks are holding the strength on the medium term to long term chart structure. And I think the way since last couple of week, these stocks are consolidating in a range only. Looks like that the strength is there, and I think minor decline should be used as a buying opportunity. Though some supply pressure is there in the after this opening, but I think for SBI Life on the downside, 1980, 1970 are the important level for near term trend. And if it's able to defend these level in this minor decline, I think again stock will resume its buying interest, and then possibly stock will show some pullback action. But the major breakout level for SBI Life is placed at around 2050. Once stock crosses those level, then I think there would be a fresh breakout trade, and then possible target further higher towards 2150, 2200 we could witness. For HDFC Life, again the similar behavior compared to SBI Life. And here also the major supply zone or breakout level for this consolidation is placed at around 800 zone. Once stock crosses those level, then here also we could see some breakout trade to play out, and then 840, 850 would be the next target. In the decline, the important support area for this minor dip is around 745, 735 zone. So that's the level where one can keep stop loss to buy in decline, as overall structure for medium term to long term is still on the bullish side. So I think minor decline should be used as a buying opportunity.
Okay, minor decline should be used as a buying opportunity when some of the life insurance names are concerned. But from insurance, let's shift focus to the pharma sector as well. Dr. Reddy is in focus. There's some negative news flow around the stock. The stock is right now down somewhere around 1% or so. US FDA has issued Form 483 with 5 observations for its Andhra Pradesh formulations unit. The facility in fact was inspected somewhere between December 4th to 12th. And if you look at the stock movement, it's up somewhere around 17% from April lows. Of course, the whole tariff tantrum thing happened, and since then the stock has recovered well. But if you look at the YTD charts, it's still down 6.5%. Given the fact that we've had the Biosecure Act as well being approved in the USA, would you play pharma through generic names, or would you look at CDMO more, the likes of Divi's, Laurus? Do you think they are the ones that are looking good on charts, or would you look at some of these generic names like Dr. Reddy's, for instance?
So I think if I look at the stability in terms of technical structure, Laurus Lab looks more attractive. Divi's Lab is still struggling to cross its falling trendline resistance area on the weekly chart, and the steep resistance is acting as a supply zone for the counter since last couple of weeks. On the higher side, 1290, 1300 are the key resistance area for Dr. Reddy. Until the stock not crosses those level, I think we may see some supply pressure to remain in this counter. But on the downside, 1200 to 1220 is the good support area for any minor decline. But if anybody wants to go in this space, I think Laurus Lab is having a stable structure, and I think the way stock is moving in high top higher bottom formation and holding the strength across all time frame, and trading about to all near term short term moving averages. So I think Laurus Lab will give me comfort here to buy and accumulate. On the downside, the one needs to keep stop loss towards 970. Once stock crosses about 1035, 1040 zone, I think the trajectory will open for 1100 to 1150 also on the positional perspective.
Okay, that's the view on some of these names, CDMO names. But let's talk about KC International. Stock is buzzing. The company has bagged orders worth 1150 crore rupees. Its largest, in fact, the largest order in India, T&D business. The stock, of course, has seen good traction now in the last 5 days. You'll see it has seen good action. But if you look at the monthly charts, down 12%, YTD as well, it was fairly weak, down over 40%. In fact, it has almost halved from 52-week lows, somewhere around 500 points away from that level. But what do you make of the recent traction in KC International? Do you think the trends are reversing?
No, still trend is on the weaker side only, and stock is still trading near to its crucial support area of this decline. Though stock is holding the previous swing low, but 670, 680 are the crucial support for this corrective move of KEC International. If it's break below 680, then we could see more liquidation in this counter, as stock is still trading below to 50-day moving average, though some recovery was there from lower level. But one needs to follow a strict stop loss of those who are positional trader. I think though it should follow the stop loss of 680 if you're buying here. On the higher side, 750 is the major supply zone for any kind of pullback. So until the stock not crosses above 750, it would be a range bound activity, like 700 to 750 would be the range bound activity for some more time for KC International.
Okay, 700 to 750, that's a range bound level. In fact, it would be range bound around those levels. That's the call on KC International. But before I come to queries, want to get in your thoughts on the shares of a PVR Inox. Stock is buzzing today, hogging the limelight, so to say. It has opened an 11 screen superplex in Hyderabad with premium formats. In fact, look at the stock. Even though on a YTD basis it's down, it saw a good pop. In the last 6 months, it has given good 13% returns. I think somewhere around October, it saw a very, very good pop as well. But at 11, around that 1100 mark, what is the chart really suggesting? Do you think it is expected to move somewhere around 12 to 1200, 1250 kind of levels?
No, trend is still weak, though there is some pullback action, but still 50-day moving average at 1115 is acting as a major supply zone for this pullback. So until the stock not able to cross and close above 1120, 1130 zone, still there is a possibility that we may see some supply pressure to remain around these levels. So breakout above 1120 on a closing basis can attract more buying action than possible extension of rally to 1150, 1180 we could see for this counter. At this juncture, those who have bought at lower level should keep stop loss around 1060 to hold the position. And if stocks attempt to cross 1120, then carry your position for next target of 1150, 1170.
Okay. That's the view on PVR Inox. But of course, the kind of blockbuster releases that we have seen in recent times, the likes of Dhurandhar, one would have hoped that the box office magic would work well for the stock as well. But let's shift focus to the queries then, viewer queries that are trickling in this morning. We want to start off with a query on Eternal. The stock saw good traction last week. It has had its off days. In recent times, we've seen the stock coming under selling pressure. Last week was good. This morning, it's in the red. Nana Prakasam wants to know if it's a good time to enter Eternal. Would you suggest?
Yeah, so stock has again, taken the support from its important support area trajectory, which is placed at around 280 to 90 zone, and almost stock is trading around those levels. So I think with a strict stop loss of 285, one can trade here on the long side. Though stock is still negotiating with its 20-day moving average supply area, which is placed at around 298. So if you want to wait for confirmation, then wait for 298 to surpass and then initiate long. Or if you wish to buy here, then you have to strictly follow the stop loss of 285. And I think any breakout over 298 may attract more buying action, and then possible extension of rally pullback. We can say around 310 to 315. That's the next supply zone for the counter.
Okay, that's the view on Eternal. But before any other queries, I'm surprised there are no queries on Hindustan Zinc. The stock has been on an upward trajectory in tandem with silver prices. Should one chase the momentum that we are seeing in Hindustan Zinc?
Yeah, definitely. So very strong breakout on the weekly time frame as well as on the monthly time frame. Stock managed to give breakout of falling trend line on monthly chart also. So it's a strong setup for near term to short term perspective also. One can buy here also, even in minor decline also one can add it. On the higher side, we are projecting target of 600 for the Hindustan Zinc, as a very strong breakout of long consolidation is taken place. buy and accumulate would be the strategy. On the downside, 545 needs to keep as a stop loss.
Okay, that's about Hindustan Zinc. But let's move on and take some more viewer queries. This one's coming in from Amit Kumar Srivastav. Wants to know your thoughts on Oswal pumps. Wants to know if a fresh entry is warranted for a time horizon of 6 months. The stock in the last 7 days has seen good traction, but it has of course shaved off over 20% if you see the last month or so. And even year to date it's down 15%. What do you make of this reversal that we have seen in the last 1 week, and is it a good time to enter for the next 6 months?
No, stock is in downtrend, and I have very limited data set up for this counter as stock is listed in June itself. So I think whatever data we have still showing a sign of weakness, and the way stock is moving in down sloping channel, it clearly shows that there is a liquidation in this counter since last couple of months from the higher level. Stock is trading below to 20-day, 50-day moving average, which is also sign of weakness. Though there was some pullback action from lower level, but still 560, 570 are the major supply zone for this pullback. Until the stock not crosses those level, trend is on the bearish side for the counter. So my advice would be avoid, as structure is still weak.
Okay, avoid Oswal pump, structure looking still weak. But let's move on to the next query from Vaibhav Vakharia. He has a query on NCC. In fact, he holds positions in this stock. His average buy price is 211.99, and of course it's giving him negative returns of over 20%. He wants to know if he should hold or book the loss. The stock is now quoting at 160, so he is making 60 odd rupees loss on his holdings per share.
I think hold it, as stock is in oversold trajectory. So there is a possibility that some pullback we could see in this counter. So I would not advise here to average it out, as structure is still weak. But in pullback, I think if you get opportunity around 175, 180 zone, where you can again review it. If setups are not improving, then exit in the pullback. At this juncture, again, 152 needs to now keep as a stop loss if you are holding it, because if it breaks below 152, then I think more liquidation of position would be there, and then stock may slide further towards 135, 140 zone also. So keep stop loss of 152 if you are holding here. And in pullback, again, take a view around 175 to 180 where the setups are improving or not. Otherwise, book around those levels.
Okay, that's about NCC. Avoid averaging at this juncture, and of course, hope Rajesh's advice helps you. But last couple of queries to go. I want to take up this query from Sameer Nayak. Rajesh, he has a query on Concord Control Systems. He says his average purchase price is 780 rupees, and he is making almost 2x profits here. He wants to know if he should book those profits or he should hold on. Any thoughts?
Okay, so stop. I'm not able to find out the code for this counter.
Okay, all right, we'll come back to it some other day then. But the stock is right now quoting somewhere around 3.5% down, 2205. That's the price for this particular stock. And of course, I think the company of course did raise some funds in the last 1 month, and of course the stock did see a good jump on the back of the fundraising as well. But we'll come back to the query on another day. But there are some queries on KC International which we've already taken up. Let's take one more query then. This one's coming in from somebody called RJD. I'm not really getting his name. Wants to know your thoughts on Delta Corp. His average price is 150, and he's been holding on to the stock for the last 2 years. Wants to know if he should look at accumulating at these levels. What would your advice be?
No. My advice would be to avoid this counter, as there is no traction in terms of business. Also, stock is continuously moving in lower top, lower bottom formation. There is no sign of recovery. So I think avoid at this juncture, and we believe that till stock is trading below 85 zone, trend is remain on the weaker side. So whatever minor pullback we'll see in this counter will attract a supply pressure only at higher level. So 85 is the crucial level for the stock on the higher side. That will decide the further extension of pullback or not. On the downside, as trend is still on the weak side, so any breakdown below 60 can attract more liquidation, and then stock may slide further to 50 45 zone also. So my advice would be avoided at this juncture for Delta Corp.
All right, avoid Delta Corp at this juncture. Hope that answers your queries. But with that, we've come to the end of the query segment. If you couldn't take up your queries, please don't get disheartened. We'll try and get them addressed tomorrow. But Rajesh, before I let you go, recommendations for our viewers this morning?
Cummins India from capital goods space is continuously attracting buying interest. Stock is almost trading at all-time high, series of higher top, higher bottom formation. So strength is there in this counter. So one can remain on the long side of trade. Possible really towards 4650, 4700 we could see. So buy and accumulate would be the strategy with stop loss of 4500. Another stock where we are holding bullish view, that is from banking space, is Federal Bank. Stock is in uptrend and almost trading near to all-time high. So here also we hold our bullish view, and we believe that 275, 280 would be the next target. On the downside, 250 needs to keep as a stop loss. And the third stock, that is from the metal space, is Vedanta. So Vedanta is also holding the strength. So till stock is trading above 530, I think one can hold or buy the long position here. Any move beyond 548 can attract more buying interest, and then we could see target of 565, 570 also.
All right, Cummins, Federal Bank and Vedanta, recommendations coming in from Rajesh. Rajesh, with that, thanks a lot for taking our time and joining in as usual. Always a pleasure, and I look forward to interacting again next week as well.
Thank you. Thank you.
Thanks a lot. Well, on that note, take a look at the market before we bring on board our next guest. Of course, the selling has kind of deepened. We opened with cuts of 50 odd points, but now the index is down somewhere around 120. So 25,900, we are holding on to that level as of now, but if that gets violated, perhaps some more selling. But as Rajesh also pointed out, if 25,900 holds, then there could be some buying emerging at lower levels as well. But yes, not looking all that great. The advanced decline ratio almost 2:3, and the mid cap index down 0.5% or thereabouts. On that note, bring on board our next guest, Big Market Voice, Sushant Bhansali, CEO at Ambit Asset Management. Sushant, lovely chatting with you. Welcome to the show. We've seen the markets, how they've behaved. There is a complete dichotomy, right? Where one side we had the benchmark indices hitting record highs. The other side, we've seen pain in the broader markets. Investors aren't really very enthused looking at their portfolios at this juncture. But a lot of these cues are out of the way now, and we are waiting for the next big cue, that's the US-India trade deal. But given the fact that the CEA has hinted that the deal could come through by March, one was expecting it to come by this year itself. Do you think that could serve as a disappointment, and we could see more phases of correction going forward, at least till the deal is in place?
See, as such, we all have made a big deal out of the deal. If you look at the exports from India to US has been not that great in terms of size, and any resultant impact of the deal and improving those exports will at least take 3 to 5 years for any meaningful gains for corporates in India, especially on the listed side. So from that perspective, I think it's more a sentiment than anything else, which has created the havoc in the stock markets for a long time. And this thing might continue for long, probably March, April, May, till the time they, I think, arrive to a common solution. This will keep on hanging. I think what participants are eagerly awaiting more so is the earnings trajectory. We have seen earnings going down for the last few quarters. They have seemed to stabilize in Q2, and we are eagerly awaiting whether Q3 will be a change in the trajectory of the earnings or not. And if that happens, I think markets are ripe for another fresh beginning and fresh sort of bullishness in the market.
Okay, earnings. That's the key deciding factor for the market. Of course, going forward as well over the next few quarters, whether we see double-digit earnings or not, that could of course decide the trajectory for the market. But any targets you have in mind for the Nifty? A lot of these global brokerages have suggested that the Nifty could in fact cross that 30,000 mark as well. Are you as bullish and optimistic for next year?
Yeah, definitely. I think 2026 will see new market highs, and all these targets are not too far away from where we are today. We are almost at 26,000 Nifty. So what you are saying is just about 15 odd percent movement from here, which is not quite big. Nifty has been into positive trajectory for now 10th year in a row. From 2016 onwards, every year it has delivered. So far, it has looks like it will deliver positive this year as well. Just a few trading sessions left. More importantly, I think as you rightly picked during the opening of the conversation as well, that index is looking at highs, but the portfolio stocks are not. And if you look at the median returns, etc., for most of the indices, they are into deep negative, and everybody believes that they are at fault and market is not. But whether in the terms of selection of stocks, or in terms of selections of mutual fund scheme, or in the selection of any other product, but the gospel truth is that the markets, all the stock, most of the stocks actually have been negative for 1.5 odd years now, and benchmark has increased more because of, I would say, highly weighted stocks which didn't do that well in the previous rally, and then they recovered. So index is seemingly at a high, but most of the stocks actually have delivered negative returns in the last 15 odd months. So one should not get bogged down
How does
by
one?
underperformance vis-a-vis benchmark,
Hmm.
because yeah,
Hmm.
sure.
Please go on. Please go on.
Yeah, so I was saying that one should not bog down by how there is a underperformance of the underlying portfolio or schemes vis-a-vis benchmark, because benchmark right now is showing something different than the reality on the street.
All right, got your point. But then, how does one, do the stock selection right now? As you mentioned, a lot of these stocks are significantly off their highs, even within the mid-cap end of the universe. And of course, the index is being driven by some stocks that didn't do well in the last cycle and are doing well right now. So, what is that one checklist one should follow while building portfolios now? Of course, it's year end. People have a look at their portfolios. They, look to churn their portfolios as well. So, where should one really look for value right now?
Yeah, there are lots of pockets, I think, where value is still sitting. Financials is one such pocket.
Hmm.
IT can be another contrarian bet, where there have been big headwinds to the sector, and it has been a neglected sector by investors for the last 18, 24 months as well. So those are two sectors, I would say. From earnings perspective, I think pharma is something which is doing really well, and one should continue to be invested in that. Alongside that, I think consumption is something where we are all expecting a big revival because of the GST rate cut led sentiment, which is probably booming the consumption, and we'll eagerly watch Q through earnings for that revival. And if that revives, I think consumption is another sector which has not delivered much in the last 2, 3 years, and it can be a big, I would say, value creator in 2026 and 27.
Okay, consumption will be a big value creator in 2026. But what about all these consumer tech IPOs that have been hitting the street of late? A lot has been debated about their valuations. Some of the names, for instance, Lenskart. How does one really value them? Because, it's not just PE that people are talking about. It's price to sales, it's PE growth, PEG, as you call it. How does one really, look at valuing these stocks, and are these stocks a good investment at the current juncture?
It's very difficult to value these as public market investors, because the traditional means of either using a simplistic some approach of a P ratio or EV beta, etc., it doesn't work into this segment. And more importantly, I think this is one segment which investors cannot be staying away from, because in few years most of the large cap, most of the mega cap stocks will be from this category, because here the incremental cost is negligible, and once the customer acquisition cost comes down, a lot of earnings will come out. And so one should look at whether there is a real business model where revenues are coming or not, and incremental cost, are they getting down from a customer acquisition perspective or not. I think as the customer acquisition cost incremental comes down and the revenue per user or per customer increases, there'll be a big earning growth in most of these plays. Of course, not all of them will, I think, survive or probably create value. So one has to be watchful. But this is one segment one cannot be, I would say, staying away from if you have to be a winner in the long term in the Indian context.
Okay, of course, one cannot really stay away from this pocket. Should one take a wait and watch approach? Have a look at the earnings for a few quarters and then perhaps think of getting into these stocks rather than jumping during the
I
IPO
would
phase?
say, yeah, so I would say that one should allocate a small portion, say about 10-20% to be in this sort of companies, depending on the portfolio size. Higher the portfolio, I think lower the allocations can be. And play a few of those names in a, I would say, not a concentrated manner. Play a few of them, one or two leaders into each such segment, and stay invested in them. I think even if two or three out of the 10 stocks you invest in, it goes right, I think it will cover up. So you have to actually take the VC approach, typical VC approach, which VC investors have taken. I think because these companies are still in that phase, and one is to take a similar approach of spraying and praying.
All right. Okay. Got your point. But let's talk about some of the other pockets as well. You mentioned BFSI, banks, etc. Of course, RBI has cut rates in its recent policy. Do you see scope for another rate cut in February? And B, what is the tactical call on banks, especially private banks, where margins have, of course, been under pressure? As a result of these rate cuts, do you expect more pressure for private banks in the near term? And in that sense, how do you really play the banking theme? Okay, I think we've lost the connection with
It will depend on
Sushant
how
there. We'll
global
try
rates.
and get it back.
Yeah, so I was
Okay, I
saying
can
that
hear you now. I
if
think
we
your
don't.
feed was frozen.
Okay, sorry about that. Yeah. So what I was saying was that
No worries.
the interest
Go on.
rates will depend on both the inflation on the Indian context as well as global rate movements. If globally rates come down, I think it will give enough food for RBI to bring interest rates further down. But we have, I think, already at reasonable interest rate levels for a good credit growth. From a short-term perspective, definitely banks will be under pressure on the margin side. But the credit growth, I think, has been not that great for the last few quarters. And I think given the low interest rate, there will be a big credit growth. And combination of higher credit growth with the lower margins should be able to still sail through the earnings in a reasonable manner for most of the efficient banks.
Okay, all right. But what's your sense in the second half when government capex seems to slow down a bit? Do you think as a result of the rate cut that we had, it could help in reviving animal spirits and perhaps private capex will pick up meaningfully in the second half? Is that the sense you're getting? And in that sense, how are these, capital goods plays looking like at this juncture?
Yeah, so it's more about how capacity utilization is in place, and our view is that the capacity utilization has reached an optimum level, and any incremental consumption will lead to private capex. I think we are seeing bits and pieces of that. Definitely, it has been a big 2025 where it started with lots of uncertainties, be it on the tariff side, be on the geopolitics side. So definitely, animal spirits were taking a backseat for some time, and hopefully in the new year, as we progress well and as many of these good news come in, then there will be animal spirits which will come back and which will lead to a good private capex rally.
Okay, that's how it's looking like. But as we go into New Year, top three themes for viewers. If I ask you for them, which ones would those be?
Yeah, so I've talked about the sectoral themes already, but I think the biggest theme will be going from India to Bharat. I think rural has lagged a lot in the last 2 or 3 years, and we are seeing good signs of revival. And if things play out well, then India to Bharat will be, I think, a big theme for 2026 and 27, which will create a big wealth for investors.
Okay, and on the rural plays, would you look at two wheelers? Would you look at some of these FMCG, rural focused FMCG? Which ones would you look at?
Yeah, definitely, or two-wheelers, even four-wheelers to that context, alongside low-ticket consumer discretionary, as well as probably a bit of FMEG players, consumer durables. I think they will be big beneficiaries of this theme. FMCG, I think, is already fully penetrated, so rural will probably add marginally, but the base of many of these FMCG players is so high that incremental growth will not move the needle too much on the earnings side. I think they will have to rework on their business models to come out on a big ticket growth revival, which other sectors are offering.
Okay, one more pocket that I really wanted your thoughts on was the insurance space. The cabinet has cleared that insurance amendment bill, 100% FDI. And of course, there were concerns about GST, etc., when the GST was removed on life insurance, etc. So, do you think with this development, we could see a re-rating of some of these insurance names? Is it on the cards?
Unlikely, because it was already 74% gradually, and 100% will not make them a big change in terms of. I think most of the global players who wanted to enter into India are already there. There are probably smaller players who would want to enter because it becomes a lucrative market from a long-term perspective. But that should not lead to relating of the large, because most of the companies which are listed in India are already large players. So it becomes difficult to do any transactions into such companies in India. And given the high growth trajectory, I don't think there will be enough sellers in this market on the listed companies in India. Most of them belong to large banking groups where there is no dearth of money. So I don't think that will do any big time revival. Probably we will see more like digital players. They getting much more benefit out of this change in legislation.
All right, point taken. Last question, really, Sushant. Of course, 2025, hasn't really been a year of equities. It has been a year for of precious metals, right? Look at how gold has rallied. Look at how silver has been consistently hitting record highs. A 90% jump in prices. So, how should one look at portfolio allocation at the current asset allocation, so to say, at the current juncture? What is the right mix, and what message would you like to give to those investors, who have or who are sitting with this sense of FOMO and who may have not been able to be a part of this stupendous rally that we've seen in gold and silver?
Yeah, FOMO never creates value. It always, I think it's more about, I think, getting your philosophy into play and making you struggle in the initial turn. If you have missed the rally of precious metals, I think better to start allocating small amounts rather than going big and waiting for the next big achievement in your portfolio. One should gradually build allocations and wait for probably in another 2, 3, 4 years, you will get another opportunity to build that portfolio. You are building the portfolio for your retirement or for next generation. So it's not too late yet. Don't get into FOMO. I would say look at what is not worked in the last few quarters, few years, and then allocate more there so that there are more opportunities. I think as you rightly picked, equity has not done well. Index might have shown something, but most of the stocks have not delivered. So that's a great pocket, I would say, to rather over allocate at this point of time. But one should have a balanced portfolio portfolio and keep on shuffling within the portfolio. Have your pockets defined in terms of various assets, and then if you have missed the big rally, then stay under invested if you are under allocated already, and not take it to optimum levels once things have played out. But don't miss on the things. I think small allocations are always good, and gradually build those allocations over the next 3 to 5 years.
All right, that's advice coming in from Sushant Bhansali, CEO of Ambit Asset Management. Sushant, with that, I would like to thank you for taking out time and joining in. And if at all we don't meet this year, wishing you a very, very happy and profitable new year ahead. And if we don't interact this year, we'll of course definitely interact early next year.
Great. Thank you so much. Likewise.
Thank you. Thanks a lot. Well, with that, we've come to the end of this edition of Opening Bell. But just look at what the markets are really doing. We are off those, days lows, but still 100 points down, near about that 25,950 mark. The Sensex down 300. Mid-cap index, there the cuts have kind of intensified a bit because the mid-cap index is down 0.6%. Breadth firmly in favor of laggards, 2:3. That's the NSE advanced decline ratio. The Bank Nifty down almost 0.5%. List of gainers fairly slim. A lot of stocks are losing ground. But in terms of sectors, I think most of them were trading in the red. But let's see if FMCG has just about managed to edge back into the positive zone, but very mild gains, so to say. Media Pack is up and about thanks to Upmove in shares of Saregama, DB Corp, and PVR Inox. Sun TV is also up and about. In terms of the sectors, it's the real estate and auto baskets that are not doing all that well. Real estate down 1%, and so is the case for the auto index. Largely, most of the sectors are trading in the red, and breadth, of course, skewed in favor of declines. So, texture of the market not looking all that great, but let's see what really happens as the day progresses. But with that, we're completely timed out. Thanks a lot for tuning in to Opening Bell. Stay tuned to Money Control for all your other news and updates, and we'll see you with the markets later in the day. Thanks a lot for watching.